there's massive defensibility and network effects in the exchange business. This means that market leaders tend to stay there and have competitive advantages and network effects, defensibility in their strategy.
All right. Welcome, everybody. Thanks for hopping on tonight. This is going to be a fun one. I'll be your host. My name is Kevin Cage. Some of you may know me from my YouTube channel. I'm an avid investor, especially in the crypto and Web3 space. And tonight we'll be diving into a few topics, including how to get started in angel investing, angel syndicates, being part of one and building your own, how crypto investing works, or crypto venture investing, and how crypto investing is similar yet different to traditional venture investing. And lastly, how to think about valuing digital assets in this nascent digital asset class. So I'd like to welcome Jed Ang and Joe Argiro. Jed, let's have you introduce yourself first.
Thank you, Kevin. Let me get started by sharing my screen.
And thanks for coming on while you're fighting COVID.
Yeah, everyone, I apologize if my voice is a little wonky. I don't normally sound this good, but I'll try to power through this thing. Can you all see?
Yes.
Yes.
Yep, I can
Perfect.
see your screen, Jed.
Thank
Yep.
you. Let me start by introducing myself, everyone. Thanks for joining. My background is as a venture builder on the operator side of the table. My last venture was building and running the world's largest API marketplace. I partnered with a company called Rapid API in 2016, 2017. They ended up raising funding from Andreessen Horowitz, and today is $1 billion company. I started angel investing in about 2017, got my first exit in 2018. That year, I also invested in Turing.com at a seed stage. They're also a unicorn. So however you count it, I've done seed to unicorn twice now. And I've got a number of other companies in my portfolio like Growwork, Electio, and others. And over COVID, I built my own, over the COVID period, I built my own syndicate. Today, I'm backed by 850 plus investors or LPs, deploying millions of dollars a year as a side hustle. All of this organic, which is to say zero marketing spend. And I started Angel School with the mission to help other angel investors build and scale their own syndicates. So let me start out very quickly by clarifying the mission at Angel School. Our mission is to help angels build and scale syndicates so they can invest at six-figure scale into their own investment thesis. So a couple of important messages here. It's about building and scaling your own syndicate. I'm not trying to co-opt and get you to join mine. That's not the mission. It's also not about getting you to invest in my deals. It's about helping you invest in your own startups. For example, if Joseph is an avid believer in Web3 and he believes he can generate alpha in that space, I want to help him. I want to help equip him with a network of investors around him so that he can do that. He can do that in the Web3 community because he knows it much better than I do. But Angel School is more than that. It comprises three things. One is the fellowship program that I teach, which is to help, again, angels get to the next level in their career, build their own syndicates. As part of this program, they are also invited to sit on my investment committee. So this is a live forum that we operate. And the students that graduate my program, they build track record alongside me. They also earn carried interest with me. And finally on the right, we've got the LP network. And it seems like there's three complicated pieces. Why do we do all of this at the same time? It's because they are very tied to each other. So the fellowship program feeds the investment committee. Investment committee becomes this governing formal body that decides on deal flow and also helps source capital, right? So in this view, all three pieces work together in a really harmonious and like synergistic way. So the things that I'll cover today will be in points 1, 2, and 3, which is to say, getting started in venture investing. If you're new to this, what do you need to know? What are your options? How do you join an angel syndicate? Which one is right for you? And finally, if you're looking to take the next step, why build your own syndicate? Before we jump into too far into the material, I'm going to cover the basic terminology to make sure that everyone understands this, just in case you might be a bit new to this space. So some of the terms that we will use today are limited partners, or LPs, which we'll refer to them as. Basically, you can think of LPs or limited partners as investors. They are either members of a VC fund or a syndicate. Then there are GPs, general partners. You can think of these as managers of the investment vehicles. Typically, they are the managers of a VC fund. People sometimes also call syndicate leads GPs. It's not strictly true, but there's an equivalency in terms of the role. Term number 3 is carried interest, or sometimes we shorten that and just call it carry. Think of carry just as investment profit. So this is the business model of the industry. Whenever investors have a successful return, they pay carried interest or carry to either the fund GP or the syndicate lead for their part in the deal of putting it all together. Next is a VC fund, which is basically a formal investment fund that LPs throw capital into. And out of that capital, the fund manager is compensated with management fees, which tend to be about 2% a year, and carried interest, which is 20%. Then there's something called a carry hurdle. A carry hurdle is a return that VC funds must return to their investors before carried interest applies. The idea here is to just compensate investors for the cost of capital. And finally, a syndicate, basically what I do is an informal group of investors that come together that invest in a single asset or a single deal. Right, so there's a distinction between a VC fund, which is where you put a chunk of money into a fund, and that fund is entirely controlled by the GP who decides which companies to invest in, versus a syndicate where you get to decide which deals to invest in on an individual basis and how much to invest in each one of these. Essentially, you get to pick your own portfolio. Okay, so let's get into this. If you're getting into angel investing, or if you're getting into venture for the first time, here are your 3 options, right? You can stay as an independent angel, you can join a syndicate, and you can invest via a VC fund. And there are pros and cons for each of these things, and it's important to understand what they are. So at a very high level, here's what they are. The first thing is about deal flow volume. As an independent angel, you can get super high deal flow volume. You can see deals all day long if you put in the work, if you've got the time for it. If you're joining a syndicate, we assume that a syndicate lead is doing a curation function and not just throwing stuff out. So that deal flow is much more moderated. And if you're joining a VC fund, you essentially get no deal flow at all, because it's a blind pot, right? The fund GP is deciding what to invest in. In terms of filtering and curation, as an independent angel, you basically get no filtering or curation at the start. Whoever reaches out to you or however you receive something, that's what you get. You can very quickly develop heuristics and mental models to improve that filtering process. With syndicates, you get moderate to high levels of curation if you're working with the right levels, with the right syndicate leads. I think proper syndicate leads should be really judicious and setting a high bar on what they invest in. And finally, with VC funds, again, you get no filtering and curation because the GPs decide everything. Next is about deal access. If you're an independent angel, you get very low, maybe moderate deal access. Essentially, it is a function of how much capital you have and you're ready to deploy, and your networks in whatever space you're investing in. As a syndicate, you get moderate to high levels of access because a syndicate is pooling capital. Right. Today, my average check is maybe $500,000. And because of that, it's an easy conversational starter to get into a startup's funding round, or at least have that discussion, right? Because we're investing $500,000, not 10 or 20 or $30,000. And if you're a VC fund, you get probably super high access because your capital is ready. The fund sizes tend to be much bigger, and VCs have this perceived prestige. For diligence, as an angel, you get no diligence. You have to do all that yourself. For syndicates, it varies a lot from very little, as in here's a pitch deck, to very high. It does depend on the syndicate lead and how much work they're putting in. And again, as a VC fund, you get no diligence. The GPs decide everything. For decision control, whether you're an angel or you invest via a syndicate, you get complete decision control, right? Because you see all the deals and you decide what to invest in or not. It's entirely your decision. With VC funds, again, no control. Time commitment, as an angel, super high time commitment because you've got to do sourcing, screening, diligence, all of that yourself. It's a real heavy lift. Syndicates, it's probably more moderate levels of time commitment because you can get involved in when you want, on the right deals. And finally, for VC funds, it's pretty low. You write a check to these guys and you get an investor update every few months. Investment minimums, independent angel, I'd say 10 to 50K is, a good broad range for what the minimum investment tends to be. Syndicates set their own policy. It can be $5,000 to $10,000 and up. For me, my syndicates, I set a minimum of $10,000 per deal, and we have investors that come in all the way up into the six figures. And for VC funds, it depends on the fund size, how well established they are. Smaller funds, it might be $250,000 ticket, and larger funds, it could be in the millions. It becomes a matter of table stakes, right? If you've got capital to play and you want something more passive, probably VC funds good for you. But if you want to diversify, pick your own portfolio, you want to choose another vehicle. And finally, the cost. As an angel, you're only responsible for the transaction fees and probably cost of your time, whatever you decide to look into. For syndicates, as a guideline, you might see 5% of your capital or less go towards fees all in, right? Like maintenance of the vehicle, your tax documentation and stuff. And syndicates also charge a carry. I charge 20%. On a VC fund, there's something called the 2 and 20 model, which means 2% management fee per year, which is to say 20% of your capital outright goes towards keeping the lights on for the fund, and you still pay 20% carry. Okay. So on balance, I know I'm biased because I love syndicates, but there are a lot of good reasons why you should consider syndicates when you get started. You get curated deal flow, higher access, you get to diversify with smaller checks while still retaining decision control. On the downside, you do give up something in terms of fees and upside, right? So you've got to decide if that's worth it for you. Next thing I want to talk about is investor segmentation. The way we think about investor segmentation is in these three buckets, or is in this 2x2 matrix. The horizontal axis is whether you are an active or a passive investor. So active investor means, hey, you love this research phase, right? You want to get to know the founders. You want to understand the mission. You want to do all of that, versus passive, which is to say, my time is important. I just want something hands off and work with somebody that I trust and let them manage my money. And on the vertical axis, it's about your capital size, right? Are you writing relatively small checks or larger checks? And we put the three target groups that we work with into these buckets. There's independent angels, which tend to be on the left side. They are more active investors. The check sizes ranges. They tend to be smaller up to, let's call it mid-size. What's really interesting for me and something that I've really learned in this process is that angel investors do this stuff because we're motivated by more than just financial return. Obviously, that's the number one thing. It's super important. I will always put that first. But we hear it all the time from investors, right? They invest because they're willing to accept those table stakes, to invest and learn by doing. There's a certain prestige because they feel like, hey, I'm part of this cool thing and it's really interesting. Some people are drawn to a mission, right? They refer to themselves as being value-add investors, for example. In the middle, there are family offices, which smaller percentage, but we also work with them. They also invest, obviously, to get financial return. And they work with syndicates because they want to diversify into a venture asset class where they might not have the expertise, right? They're more traditional equity investors, for example. Syndicates provide deal flow and expertise that they don't have. And finally, there are fund LPs, people who invest into VC funds. They invest for financial return. They bet on the fund manager. They want to be hands off. Largely doesn't really work for syndicates. So let's start with some basics. If you're getting into venture, right? What are things that you should do? I think it's super important to start with defining what your investment thesis is. Right? At a very high level, investment thesis is three things. It's about what sectors or domains do you invest in? Is it Web3? Is it hardware? Is it consumer tech? What geos do you invest in? Which part of the world, basically. And thirdly, what stage of company do you invest in? That's often a function of the capital that you bring. Right? Your goal in asking yourself these questions, and it doesn't have to be a big, complicated exercise. Just be clear about these things for yourself. And if you want to invest via syndicate, find a syndicate lead whose investment thesis aligns with yours. That is the best thing that you can do to make sure that you're receiving relevant deal flow so that you're efficient with your time. So next topic, I'm just going to quickly touch on why should you build your own syndicate, right? Why would you do? Because it does sound like a bunch of work, and it is. The number one reason, the triggers that get angels to go from writing their own check into thinking about building a syndicate, right? Those trigger points are as follows. One, you've done a number of angel investments. You get to a point where it's like, hey, I've invested a bunch of stuff. I'm starting to run out of money, or it's starting to feel really risky for my overall portfolio, right? Like I've got too much in this stuff that's kind of illiquid. What do I do? And so the syndicate is a great vehicle to lever up on capital, right? It's about aggregating capital, it's scaling it up through a network instead of writing your own checks all the time. Three main benefits here. One is carried interest. So you get to earn on the upside on the capital that you raise. Second is you get to perform much better due diligence because you're writing a bigger check, right? The founders that you work with are going to answer a lot more questions when you're writing $100,000, $200,000, or $500,000 check instead of a $10,000 one, right? Nothing wrong with the small checks. Everybody's got to start somewhere, but the founders have a right to choose. And the last lever is writing a bigger check also improves or moves the needle on deal flow quality. You get better deal flow access. So I want to quantify since we're all investors here, I want to focus on the first argument, which is the benefit of carried interest. We're going to look at this from 2 points of views. One is as an independent angel, and second is comparing a syndicate to a fund GP. So let's look at scenario one. You are an independent angel or a syndicate, and you invest in a company that generates a 10x profit. So this first scenario on the left is I'm an independent angel. I deploy a $20,000 check. I get a 10x return. I get 20K profit, which is 1,000% ROI. Hey, not bad. But on the right, imagine you invested personally $5,000, but you aggregate $100,000 of capital through an LP network. Your 5,000 becomes 50K in profit. The 100,000 becomes $1 million. 20% carry becomes 200,000. And so on the right here, as a syndicate lead, you've got $250,000 in profit on 5K capital at risk, 5,000% ROI. Very simplistic example, but it shows you the scaling effect of capital and carried interest. Now, the more interesting argument is comparing a syndicate lead's returns versus a VC fund. And I want to ground this in some reality, right? So we're going to use market data. This histogram shows US VC capital returns for a 10-year period from 2009 to 2018. And the way to read this graph is that in that first bar, 51% of capital returns less than 1x. So basically you lose money on that portfolio. 30% of capital returns 1 to 3x, and so on and so forth. If we deployed $5 million, this is what it would look like. $2.5 million goes into the first bar of losers. $1.5 million goes into the second bar, and so on and so forth. Now, this is where it gets interesting. This is how the math works out. The first 4 columns, right? This is the math that we just walked through. 5 million capital deployed basically returns 11.5 million capital or 6.5 million profit if we were completely average performing investors. Now, if you were the GP of a fund, 20% carry returns 1.3 million. Okay, not bad. But remember that VC funds also have a carry hurdle, and that's around 7% a year. And let's say you don't return that return hurdle, that's 7%, and it compounds for 10 years. Your carried interest as the GP actually diminishes down to 342 in an extreme scenario. So as a fund GP, your realistic outcome is somewhere between 340 grand and 1.3 million, right? Whatever that number is. Now, as a syndicate lead, this is what the math looks like. What's interesting is that since carried interest is calculated at the deal level and not a portfolio level for syndicates, this first row here that returns less than 1x, that becomes 0, right? There isn't a negative on the balance sheet that lowers your overall investment profit. And so for the syndicate, here on the identical portfolio, I generate 1.5 million, whereas the VC fund GP is generating somewhere between 300 and 1.3. So there's a real meaningful economic advantage here, right? So this is why I do what I do. So let me end with this. Closing advice, if you're starting out today and knowing what I know, I would say this. Pipeline is super accessible. Go look at a ton of things and take your time, right? Don't be pressured or hard sold. There will always be another deal. Second, right size your risk perceptions. I probably don't have to communicate this point too hard because all of you or most of you come from Web3. Venture investing is illiquid, blah, blah, blah. Contextualize your risk in the right frame. I play to get multiples exit. I'm playing for 10 or 50x or 100x exits on my capital. If I lose that money, I accept that risk, right? But so think about that for yourself and whether this makes sense for you. Number 3, invest within a thesis. I think it's very hard to find alpha as a pure generalist if you just spring and pray. Look at a lot of stuff, figure out what you like, work with people that fit with your agenda. Number 4, play for life-changing outcomes. I've got a company in my portfolio that is a unicorn. When they exit, it's 100x multiple. That is a 1 in 10,000 event, or even less. I don't know what that exact number is. If you invested $500 or $1,000 into this company, and that became and $1,000 becomes 100,000, it's like, so what, right? It's a nice payday, but it's not that big a deal. So invest in life-changing outcomes is my point. And finally, basic investor rights. Don't ever let anybody who's more experienced try to push you around on this. If you're in doubt, walk away, trust your instincts. There will always be other deals. Don't put up with high pressure, closing deadlines, stuff like that. Don't fall for it. Just walk away, right? And don't accept minimum annual requirements to be part of a group. You shouldn't join a syndicate and they're like, oh, you got to invest in like 5 deals a year or something like that. That's kind of BS in my books. If you're working with syndicates, number 1, are they thesis driven, right? Don't invest or deploy capital in syndicates that are just generalists. I don't think it works. Find out what drives incentives. I think you should invest in companies that play for the upside, not upfront fees, right? So that's a scenario where somebody's just going to take your money and walk. Number 3, maximize alignment. Find out if they have skin in the game. Number 4, diligence is your right. Syndicates, if they're going to take their pound of flesh, they owe you something for it. And I think diligence is that price, right? If all they're giving you is a pitch deck, then they haven't done the work. They're lazy. Find somebody else. That's it. I guess we're holding questions. So I'm going to switch screens and let Joseph take over now. Thanks for listening, everyone.
Thanks, Jed. That was awesome. Just going to introduce Joe. He is the founder and CEO of IronKeyCapital, digital asset hedge fund.
Thanks, Kevin. Yep. So a lot of what I'm gonna talk about is relates back to some of the concepts that Jed pointed out. So let me know when you guys can see my screen. Kevin, if you just confirm that.
Yep, we're good.
All right, great. So I guess just start with a little background on myself. I'm also on the operator side, like Jed. Been involved with multiple startups in and out of the Web3 space. My first venture was back in 2015 when the Uber for X business model was very hot. So I built Uber and Airbnb for college tours. I made a lot of mistakes through that process and ultimately failed because I didn't understand platform economics and how the marketplace platform business model works. So I walked away from that scratching my head and read a bunch of books on the subject, and eventually got hired at Hewlett-Packard Enterprise to lead their marketplace and platform business strategy globally, cross-functionally across the entire organization. But before I did that, I was working in valuation, derivatives valuation at Vanguard in the summer of 2017. And I realized that when the price of Bitcoin started going up, I realized that blockchain is actually just the next evolution of the platform business model. And the platform business model was a business model innovation. And blockchain now abstracts that to the technology level and allows the matching engine to happen on chain. So in the summer of 2017, I took a job at ICOalert.com, which was essentially the coin market cap of ICOs. If you Googled ICO back in 2017, we were the first search result. And through that process, essentially we were a platform that connected retail investors to the blockchain startups themselves, which were called the ICOs, and allowed them to connect and invest through that platform. So through that experience in scaling that company to 25 plus people, I saw about 50 to 100 data points on every single blockchain startup that's ever existed. So when the market collapsed, during that process, I was responsible for aggregating, synthesizing, reporting on all of the objective investment information associated with these startups. So the market collapsed in the back half of 2018, and we lost all of our business since the startups held their treasury in Bitcoin and Ether, and they didn't manage their treasury well, so they had no money to pay us, the platform, to connect them to investors, and essentially everything fell apart, which was fine. And then that's when I moved on to Hewlett Packard Enterprise for a couple of years to lead the marketplace platform strategy and blockchain enterprise strategy across the organization. And through that work at Hewlett Packard is where I developed my investment thesis on enterprise blockchain and utility-driven digital assets, which you can read more about on IronKeyCapital.com. If you go to the blog, the research section, you can see the sticky post, which is a 10-page white paper that outlines why I think that and what are the implications there. Just real quick, in terms of what that means is that back in the 2000s, early 2000s, internet investors got really excited about the intranet, which allowed companies to have visibility across the organization globally, and that was exciting because they could have more increased transparency. But actually, that was the equivalent of losing sight of the forest through the trees. What actually the real innovation was actually the open internet that allowed for the democratization of and access to information worldwide. And crypto and blockchain technologies are actually doing the same thing in terms of democratizing access to capital formation worldwide. So the same type of profound impact as the internet the first time around. So that's just a little bit about me, and I'll kind of just keep going into more of what we're doing here at IronKeyCapital, and specifically as it relates to angel investing with a crypto spin on it. So as most of you are familiar with how an equity agreement works, it gives you ownership rights to cash flows and future profits of the business after debts are paid. It's pretty well understood. What happened in 2017 and 2018 was essentially innovation in capital formation via these ICOs, right? Initial coin offerings. So the legal structure of that was a simple agreement for future tokens, or a SAFT, as they called it. They're now actually frowned upon, and there's better ways to raise capital in the crypto space, but there was no real assurances for investors. Since you're not receiving equity, investors had little protection. You're basically trusting anonymous developers around the world. And there's lots of scams. We got about 90% of startups that applied to be listed with us at ICO Alert were essentially scams or really poorly formed projects. So basically, this was really just an innovation in how to raise capital and crowdfund in a frictionless way, and likely illegal. And they didn't return any value to the token holders, which were the initial investors. And that's a really important point that I want to touch on later, returning value to token holders. We'll discuss that later on. So long, short, the core innovation here was democratizing access to capital formation. And then fast forward a couple of years, 2021, 2022, crypto goes mainstream. I'm not going to discuss why it makes sense for every investor to have exposure to digital assets. That's something we can cover at another time. And if you want to learn more about that, feel free to contact me if you're looking for clarity there. So in terms of crypto going mainstream, the standard in crypto venture operated under the legal structure of a SAFE plus T. So a SAFE plus T is a simple agreement for future equity plus rights to a token warrant. So what that means is it gives investors pro rata rights to a portion of the token allocation when it does launch in the future. So it de-risks the investor a little bit because it's not a SAFT. So you get equity alongside rights to the token. So you can actually think of it. One way to think about it is like an equity investment with a long dated call option on the token. It's almost like a moonshot. That's one way to think about it. So that's a SAFE plus T. So what are the implications of a SAFE plus T? So you're really betting on what you really need to understand, and this is actually poorly understood by the market investors, is where is the value actually going to accrue here? Is it going to accrue to the equity or the token? And there are a lot of prominent crypto VCs that are actually billion-dollar venture capital firms that would argue and do argue that the equity is actually worthless, and they just want to fund the teams that are building the protocol and have access to the token. These types of investors probably have a 10-year time horizon. We don't necessarily agree. We think it's more nuanced than that. And it actually depends on the underlying business model. You can actually build an entire business model in Web3 without a token economic component. You can also build a business model that is solely interdependent and intertwined with the token itself. So there are, from what we've learned over the past 4 years, is that there are actually very, very few instances where value can accrue in the long run to both equity and the token. And one exception here is Binance Coin, which I'd like to circle back to at the end. So one way to think about it is that if the token is being offered to everyone, and it's a real business, it's a Web2 business, and then they're selling the token to everyone, but the equity isn't being offered up or for sale, that's an immediate red flag or a signal to say, hey, this company is actually just harvesting token profits to run their business, and little to none of that value is going to accrue back to the token. You can essentially think about it of like moving money from one pocket to the other. And this whole idea is just not talked about in the investor community because founders don't want to field this question because it's uncomfortable. But we're going to talk about it here. So the next part of this is, so if I invest in a SAFE plus T, isn't my exposure covered? And the answer is not necessarily from a risk-adjusted return perspective. You actually have to look at how much of the token supply that you're getting as part of that SAFE plus T. So an investor must underwrite the amount of tokens that they're receiving divided by the total token supply, which would allow them to calculate the fully diluted token value in the future that they would receive based on that deal. So investors must understand the token supply vesting schedule and the dilution tactics, commonly known in the crypto space as tokenomics. For those who don't know, tokenomics is analogous to a shares outstanding calculation in traditional finance. So now let's move on and just talk a little bit about asset valuation. So crypto assets are a new asset class, right? In every asset class, there are supply and demand considerations to be thought through. The first, supply side, is fairly quantitative and fixed in nature. This is really around, in crypto, this is really around how much of this token is going to be distributed over time. Things to consider are inflation rate, token lockup periods, how much of the token allocation is Are big investors known as whales in Web3, are they holding most of the token? That's a risk in itself. Does the token actually, is it necessary to facilitate economic activity within the crypto economic network? Or is the token just actually a money grab by the company? So then you move to the demand side of the equation. And when you're evaluating a crypto asset, you are really forecasting the demand similar to the way an angel investor or a venture capital firm would evaluate the future anticipated demand for those network services. So that is a total addressable market calculation. That is a forecast. So there are various, inputs and quantitative metrics that can go into that forecast, but that at the end of the day, you're making assumptions and you're trying to forecast future demand for a service that really, doesn't have traction or much traction and really doesn't exist yet. So very high in the sky type analysis, right? So the next, as we move down the chart here, we look at Bitcoin and monetary assets. One well-accepted framework for valuing a monetary asset such as Bitcoin is the equation of exchange. This is, people say it's MV equals PQ. M is the money supply. V is the velocity of money, which is the amount of times that money changes hands over the course of a given period. P is the price of goods or services in a certain economy, and Q is the quantity or the GDP of those goods and services. So if you want to learn more about this type of quantitative fundamental analysis, you can do your own research and look into this, but what you'll find is that the deeper you go here, the more this model begins to break down. And this is because this is a new asset class, and actually this is a new technology that will underpin every single asset class for the next 100 years. So the next bucket that we talk about in crypto that's widely understood is smart contracts. These are Ethereum and its competitors. So there are various ways to go about valuing these smart contracts. One way to think about it, and I think it's in the right ballpark, is that each layer one blockchain can be viewed as a country, a nation state, or a city. But let's just use country as an example for now. A country has a native currency, and there is usually a risk-free rate. I use risk-free in quotes. That's yield for holding that native currency that operates payment for goods and services within that economy. And there's usually a risk-free yield for holding that asset. The same thing exists with smart contract platforms. There's usually a yield for staking or locking up that asset. That is obviously this concept of staking or locking up your tokens to receive more tokens is not risk-free. You actually have protocol risk, which is smart contract risk, which is essentially cybersecurity risk, and we'll go into that in a second. But essentially, what you're getting is fees from transactions and token rewards for people who are willing to sacrifice their liquidity so others can have access to or bandwidth on network resources. So now, as we move into 2021 and now 2022, we see that protocols now actually are producing real revenue. So what that means is that cash flow analysis is now possible here, and relative valuations are possible. So what you can do is you can actually calculate price to sales metrics and price to earnings metrics, and then line that asset up next to its competitors and say, this asset is trading at a 40% discount to a similar asset with the similar characteristics. You might have heard of the concept of TVL, or total value locked. This is the amount of monetary assets that are staked or locked up within a specific protocol. And if you read more IronKeyCapital.com, you'll learn why TBL isn't such a great metric standalone. So the conclusion here is that there's no one size fits all model for valuing digital assets. It's not like a discounted cash flow model. You actually have to apply a new model for each type of digital asset. And again, this is a new asset class. And what we see with Ethereum and the merge coming out in the next month is that Ethereum is going yield generating, deflationary, and ESG friendly all at once, which has the potential to drive serious institutional capital flows as we move into the back half of this year. So that's a little bit just a primer on crypto asset valuation. And now I'll just go into a little bit about risk management within the crypto space. This is very important given that it's a new asset class. So there are 4 different risks that come to mind that are at the top of our mind. And I just want to dive into a little bit of each one. So the first is operational security. This is paramount for any crypto asset investor, right? This is about keeping your private keys safe so that a hacker, a man in the middle can't steal your keys. So what the fund uses and what any serious institutional counterparty will use is what's called multi-party computational security. And this is essentially cold storage where it splits up your private key into 3 different locations. So in terms of the fund, you have a fund administrator who has part of the key, the bank has part of the key, and you have part of the key, which acts as a trust mechanism to keep everyone honest. So that's operational security and keeping your key safe, which is very important for any crypto investor. The second is counterparty risk. This is the underwriting each exchange that you use, so you don't get caught up in a situation where the exchange, the centralized company that's running the exchanges goes bankrupt and then you don't have access to your funds. That's counterparty risk. The counterparty risk is very, very real in crypto. These are things that you just don't really have to worry about in traditional finance because there's already been 100 years of case law that have kind of shown you what's acceptable and what's not and best practices. So this is kind of the Wild West. So smart contract risk is the third. This is underwriting the cybersecurity risk associated with emerging technologies. We have an advisor who focuses solely on operational security and protocol smart contract risk to make sure that we're making these wise decisions. But at the end of the day, these are risks that are on the table for sure as an investor in this asset class. The fourth is price and volatility risk. This is pretty well understood, but in crypto, what's needed for successful long-term outperformance is the systematic de-risking of profits. This is because crypto goes through boom and bust cycles. It's necessary to take profits and take money off the table and recycle that profit into, in this case, Ethereum or interest-bearing stablecoins or whatever your risk-free asset that you deem. And so I just want to rattle off a couple more risks that I'm not going to go into detail. And this will kind of help you get a full picture of the dynamic landscape that we are dealing with here when it comes to liquid digital assets. So here's some more risk that we're watching at the fund. Systemic risk, unknowable risk, whales and or miners selling risk, the opaque nature of Tether's reserves, Tether's court cases, blog posts about Tether from anonymous sources, user data hacks, exchange hacks, hard forks, exit scams, scammers, code bugs, rehypothecation, tech obsolescence, GBTC NAB trade unwinds, death spirals, aggressive market makers, price manipulation, forced sellers, liquidity crunches, Satoshi's alleged 1 million Bitcoin position, global macro risks, looming regulatory risks. For these reasons, we think crypto investing is like liquid venture capital. And it probably makes sense to outsource this if you want long-term sustainable returns. is akin to liquid venture capital. We've seen assets that can go to zero. Terra Luna has gone to zero. Celsius is bankrupt. If indeed this thesis is correct and crypto asset investing is indeed liquid venture capital, it is necessary to stay diversified across asset types and sectors within digital assets. So why do we do what we do? We do this because digital asset investing requires the application of public market investing techniques, i.e. systematic profit taking. It also requires access to an understanding of venture stage tech investing. This dynamic landscape demands active portfolio management and flexible investment strategies with a strong focus on risk management. So this is our mission. We combine systematic trading techniques to manage risk with a thesis-driven venture-style research framework, focusing on the enterprise adoption of digital assets that solve real problems, whether in the Web3 space or actual real-world infrastructure, which we can talk about at the end as well. So we offer diversified risk managed exposure to various sectors of the digital asset ecosystem. And essentially what I'm talking about is a venture-style research framework with a systematic overlay to capture market inefficiencies and remove emotion from the investment process. So here's just a little bit of comparison to some other alternative investment solutions in the crypto asset investing landscape. The Bitwise 10 is more of a passive index exposure to the large cap digital assets. And what you'll find is that IronKeyCapital, it takes a multi-strategy approach. We are multi-strat because this asset class requires you to be light on your feet. For example, DeFi, decentralized finance, had a massive year in 2020, and now no one really wants exposure to these insanely high APYs and yields because now we know that they're unsustainable and risky. So a concrete example of something that we can do and maybe doing right now is having exposure to a GameFi metaverse and actually owning land in that metaverse. And that land is actually an NFT. And we can hold that NFT in the fund. So that's just an example of the types of things that we can do here. But to be honest, right now, we are more focused on core Web3 infrastructure and picks and shovels types investments. But I'm just kind of giving a broad example of what's possible here and what we're evaluating, not necessarily what we're currently actively investing in. So if we think about other fund competitors, you definitely want to line this up against syndicates and crypto venture capital firms, right? So we operate on a 2 to 5 year time horizon because we don't think it's possible to predict what's going to happen, especially in this asset class on a 10-year time horizon. So we are more flexible than a VC. We're actively monitoring portfolio positions, and if we don't see product market fit or traction, we can exit, and sometimes we're exiting at a 2 to 3x profit, which is just not possible in traditional VC. We're also more liquid than traditional VC because it's a liquid asset class. The majority of our assets are in liquid tokens. We offer investors quarterly redemptions, and it just doesn't make sense to have a 10-year lockup on this like a traditional VC does. The third bucket, and arguably the most important, is regulatory considerations. So we believe a lot of the innovation in general in technology occurs at the edge of what's legally possible. However, we do consider international regulatory frameworks when making investment decisions. So this is ISO 222 compliance frameworks that are being communicated across governments. So we like to, I like to say, split the baby down the middle in terms of having exposure to, call it pro-decentralization theses, where the thought process is, hey, let's disrupt banks. We don't need them. Let's cut out the middlemen. And the other is how are banks and asset managers going to integrate this technology and adopt it? So we look at it from both sides of the spectrum and are investing in both of those theses. Investing in just one of them carries a massive amounts of regulatory tail risk, and we're just not prepared to take on that kind of risk. It's nice from an ideological perspective, but that's not an investment strategy. So as you can see from those specific points, we are more diversified than VCs and a Bitwise 10. Getting exposure to the Bitwise 10, there's a lot of dead technology in the top 100 of crypto assets that's actually just not getting used and not getting adopted, and still seems to hang around. So passive exposure to the top 10, top 30 crypto assets is not the right way to go about investing in this asset class either. There's a massive opportunity for active management in emerging technologies.
Can I ask one risk question? What's the risk of future tech?
The risk of future tech. There's definitely a lot of risk in future tech, in future technologies, leapfrogging existing technologies. You can think about it like pets.com or Netscape or Ask Jeeves, the search engine that came around before Google. That's the way we look at it. Any of these technologies could end up being obsolete and get leapfrogged, which is why it's necessary to stay diversified. Does that answer your question?
Yeah, that was exactly where I was going.
Appreciate it. Okay. So where are digital assets headed? So right now, digital assets are driven, and they're still driven by narrative economics. This is what you read about in the news. This is Shiba coin, Dogecoin, Dogcoin. These things have no use case. They are simply like an AMC stock driven by retail traders, right, that are looking to capitalize on hype. And there's no fundamental value here. We think, and we see crypto investors getting smarter every day and more sophisticated. So digital assets with utility that are provisioning network resources for consumers and enterprises, these will drive adoption moving forward. Consumer-focused applications like Solana blockchain and Flow, we've seen them gain adoption over this past 12 months. This is the likes of, profile, monkey picture NFTs, these types of things. That's where the puck is right now. We are moving to where the puck is going. This is enterprises and big tech are beginning to adopt public blockchain networks. This is every big tech company is now sitting in their innovation lab thinking, hey, what is my public blockchain network strategy? And I've just been seeing it happening across enterprises for the last couple of years. They're now, a couple of years ago, they were just starting to tinker with the technology. And now it seems that enterprises are ready to safely integrate digital assets, whether they have monetary value or not, into their existing technology workflows. So through that process, we've seen blockchain-based gaming. These games are popping up all over the place. They've garnered attention from retail and institutions alike. A16Z has a $600 million games fund, VC. We think this is interesting, but we think that there's new crypto use cases that we're seeing come out right now. And these are in big data, IoT, even AI. These are the types of use cases that we're looking at. If you want to learn more about this, you can just check out our research blog. Go to IronKeyCapital.com. You can learn more. Follow us on Twitter. So disclaimer. And yeah, so I just wanted to just take a step back and kind of come back to the beginning of the conversation and talk about the elephant in the room, which is how do these networks accrue value? And why should value accrue to the token when it could accrue to the equity in the company that's issuing or running the token? So I mentioned that usually it's actually one or the other. We don't usually see this symbiotic relationship. we do with Binance Coin, and not in the fund, but I invested in Binance Coin at $10 in 2018, and for these reasons. Binance Coin proves clear utility. Users of the Binance exchange, which is essentially, for those who don't know, it's essentially Coinbase for the rest of the world that has a token. They incentivize very sticky user behavior by offering 50% off trading fees just for holding the BNB token on the exchange. And what that does is it reduces the token velocity, which drives the price, which drives tokens out of the circulating supply, which drives the asset price up. So Binance, there's massive defensibility and network effects in the exchange business. This means that market leaders tend to stay there and have competitive advantages and network effects, defensibility in their strategy. That's very, very clear in terms of the exchange business model. One thing that I really want to touch on is deflationary token structure incentives. So the reason why BNB was so revolutionary, and this is before even DeFi or decentralized finance even existed, BNB figured out how to align incentives between the token holders and the users. Binance, the company, the centralized company, decided that it was going to take 20% of its profits and execute token buybacks, share buybacks, to buy up to 100 million BNB tokens, 50% of all BNB in existence. They returned $88 million to token holders throughout buybacks in 2018. This is the discount and payment token model. They offered discounts on trading fees, and they were actually willing to cannibalize their own business model to build a decentralized exchange. And what they did is they took BNB, they turned it into a yield generating asset that you can stake and generate passive income from. They further expanded their ecosystem, building this decentralized exchange, listing more coins, offering more fiat pairs, more advanced financial products, futures, and whatnot. This is essentially what allowed Binance to be so successful. So this has created a way to share platform revenue with token holders. This is truly revolutionary and first of its kind. Does anyone have any questions?
Yeah, I absolutely love that flywheel.
Yep, and yeah, I can just kind of talk about one of our other IoT investments while I'm in the flywheel state of mind, I guess. So one thing we do at IronKeyCapital is we have our general fund theses, which I described around the enterprise adoption of utility-driven assets. And then we also have sub-theses that we invest directly into. One of them is called proof of physical work. This is the idea that you can actually build real-world infrastructure using crypto economic incentives. And the Helium network is the first of its kind in this specific sub-thesis. The Helium network solved a massive network problem that exists between Wi-Fi and cellular data for IoT devices. Wi-Fi has high bandwidth, but it's doesn't have long range. Cellular data has long range, but it's actually not cost effective to be used for IoT devices. So the Helium network came along and said, we're going to flip this business model of telecommunications that Verizon and AT&T are operating, and we're going to flip the business model on its head. And we're not going to invest in fixed upfront infrastructure in towers, manpower, cell towers, those types of things. We're not going to do that. We're just going to have people propagate the network via hotspots to provide that connectivity that enterprises can now pay for exchanging real world data at the edge. Think about sensors on traffic lights. Think about pet trackers, soil optimizers in a farm. These are in areas of inherently low connectivity where cellular data is not cost effective to use. We actually just made our second investment within this proof of This will be out next week or two. But this is a decentralized manufacturing network that's backed by Paul Allen's fund, the co-founder of Microsoft. So these are the types of investments that we're making to capture these risk-adjusted venture-style returns in liquid crypto assets. So I can definitely open it up to questions if anyone has any questions about anything that I touched on. I don't see the chat here, Kevin, so I'll lean on you a little bit.
Yeah, feel free to text or just hop in voice, guys. I was just reading that Nike, the company, sold over $185 million in NFT drops alone.
Yeah, Kevin, I was looking at that, and actually, for my analysis, what I found out is that actually the secondary sales are driving the majority of economic activity there, which is super interesting. It's the resale value that's generating, I think, 85% of the value. The value exchange is in the secondary market for brands in NFTs.
Gotcha. Yeah, I saw the secondary sales brought it over like 1.3 bill, including other companies like Gucci and stuff. Oh, so we have Holiday Hadley. That was a great description of what you guys do. I think I'm just starting to take it in. Awesome. Yeah, thanks for tuning in. I learned some things from Jed. See if there's any other questions. Otherwise, we can call it a night.
Sounds great. And we'll get the recording together and all the materials and share it with everybody in case you want to check it out and reach out and speak with us.
Awesome. And thanks again for everybody for joining in.